Hi folks, here we'll be talking about risk tolerance as one of the conversation point and how you manage your funds based on that. So there are a couple of things which we will go through and I will try and explain the best scenarios uh, as we proceed with the conversation. But what it means essentially is you're telling the algorithm that if certain trades don't go as per my expectation, then do immediately put a break into it. That's what you're trying to tell him. So what you're doing is, say for example, you have $100,000 and you have kept your risk tolerance at say 0.25%, which means you are taking a risk of $250. What it means is, say for example, let me draw it here if I can. Of course, you have to bear with me that the drawings may not be so good, but let me try. So assuming that you are probably investing on three stocks and your expectation is it'll go north. Say you have three stocks which you have invested and your expectation is it's heading north and you're going on a long position with these. Okay. But for whatever reasons, and I'll come more details later on as to how you prepare your list and get into sweet spots and all those stuff. But for whatever reasons, the market was not in the direction as to what you expected, and these stocks started heading south. So that's the scenario. But as it heads south, it did not, although you might have a stop loss somewhere here. You might have a stop loss at say, probably say at 2% or 3%. I'll come to all of those a little later. Now what you're doing here essentially with this 0.25% which you're telling is as your unrealized profits, because this is leading to unrealized profit from all the three stocks, as your unrealized profit heads towards 0.25% of your total portfolio, you don't want to do any more investment. That means the algorithm, although you might have say 10 stocks on your list, but the algorithm is restricting you to only invest in three of those till this guy gets wiped out and again, say for example, this went down as I said, and then it again took a turn and it went north. That's the situation you're looking for. So a trade went against you and it again started heading north. So this is what you are asking the algorithm to do at this point, that you are stopping investment, new investment. You might have cash, but you're stopping your new investment till it takes a turn. So as it takes a turn, obviously, if you are at, say, for example, I'll give you an example here now. Say you have invested, let's start from a very small amount, $10,000. And you're saying that I'll have a tolerance of 0.25%, means you're taking a risk of only $25. So when your net worth is below $9,975, it'll stop the new investments. You might have a list of say 50 stocks also, doesn't matter. We'll come to that later, but it will stop all your brand new investments. So that's one way you mitigate your risk. So now say you have $10,000 and you are probably say investing $5,000 on each stock. So maybe you will be looking into at say probably two stocks which invest $10,000. So you have already taken, see if you look into your unrealized amount of 0.25%, if that was the case, then these unrealized amount as it went down to $25 from the two stocks, all the investments are stopping. So the The point I'm trying to make is whenever you are, so let me clean this up a little bit so that again I can draw something different. Let me say it is as new. So the point I'm trying to make is when you are making your stock selections as we come, we will get into that detail later on. Your expectation, if you're saying that, okay, I want to go long, your your expectation is it is going north, the stocks are going north, and if that's the criteria, and if that's exactly what it is happening, you will be below 0.25% on the tolerance because you'll be making profit. Say for example, your cost was somewhere here, your cost was somewhere here. As an example, you're heading north. So this is your territory of profit. So your unrealized profit in that case will be in the positive zone. So the breaks the algorithm will put in if your selection of stocks for whatever reason and the day you have invested, the time you have invested, it didn't go in your direction. So that's one of the key criterias of how you control your risk when it comes to the total portfolio. So let's take another example. Say for example, you have got say $50,000 and you're saying that I'm willing to lose because that's the first thing you're trying to tell the algorithm that I'm willing to take a risk of say $500. So I'm just giving an assumption. So in that case, you're saying that okay, I'll take a risk of 1%, which means $500. That means my net worth, if it goes below 49,500, I'm going to stop new investments. But again, with this $5,000, I mean $50,000, say for example, you have say 10 stocks at probably say $10,000 each. So what is happening is even if the unrealized amount goes down by 0.25% means you are expecting it to go up, but it went down and then again it came up. So this range is your 0.25%, which I'm talking about at this point here. Your stop loss could be at 1%, 2%. That's a different thing, which we will talk later. But the point here is if the direction of the stock, whichever way you are trading, whether it's long or on the short side, is in your favor, then in that case, this unrealized amount will not be, this percentage will not be so effective because you're already doing well. Your unrealized profit is more than the tolerance, I mean less than the tolerance of course, and you are heading north if you're going long. So the same holds when you are doing shorting, that you can probably also think about this way, that when you're looking into shorts, let me put take in as new. Short means you are going south, means a stock is expected to go south, and that's where you are. You want it to go, but for whatever reason, it did not go that way. The market turned bull and all those type of things happened and it went north. So this is a situation again of unrealized profit. So which means that you are heading in the wrong direction of your trade. So your stop loss could be here. So we'll talk about that later on, what will be the optimum stop loss and all those stuff. But till this guy comes down, you will not, and you're controlling the risk factor and the tolerance here, new investments will not happen. So the point here is very crucial for people to understand, and especially who are beginners. The best technique, The goal is obviously to execute a trade at the right time, which we call it as a sweet spot, so that the unrealized amount is kept low. Say for example, here I'm willing to take up to $500 risk. If because of my performance of these stocks, my unrealized amount is say only $200, then I'm fine. I'm very much um, in a controlled zone of my risk. So having said that, these are the few key elements which one has to take a note of while setting up the parameters. So if you are looking into an investment of say $20,000, and you say that out of this $20,000 I am okay up to $200 risk. So what you're doing is you're telling the algorithm that okay, I'll be taking a risk of only 1%, because risk is a component which you have to let the mathematical model know that at what point the algorithm will put brakes for you. So this is exactly what you're trying to tell him. Now, say for example, you have got out of this $20,000, you are investing say on 4 stocks of $5,000 each. And your unrealized profit is at say 0.25%, means you are at $50 range, which is way below that risk which you have taken. So it might go and invest again on the 5th stock from that list. So it will take a risk of 0.25%, assuming where your unrealized profit is $62.50. So the right time to execute a trade is so crucial, because uh, as you can see that when you are trading, I'll again get into a new screen here again. If you're trading on the long side, that means your expectation is that okay, at the time when I enter, I should be going north. That's your key expectation. So the faster you go, the faster you milk out your profit and you get a gain trade, because your cash will be available and all those stuff. I'll come to it later. But if the trade happens to go on the reverse direction, then under those conditions, you will notice that the algorithm is not trading anything else for you. It is waiting. Your stop loss could be somewhere here, but it'll wait till the stock takes a turn. So there are two elements here. One, that at the time when you are investing, assuming you are going long, you want it to go north right away. No waiting time. So that means there is a very important element of as to what time you should be investing, which we call it as a sweet spot. We'll come to that later. So if you can get into this scenario, then what will happen is even if you have say $10,000, $20,000, by the end of the day, and you are coming in, going out, coming in, making profit, releasing your cash, again coming in, you might be trading like maybe 10 times in a day, and you're coming in making a profit out of each of those, because the algorithm will allow you to keep trading if you're within that tolerance percentage. So the 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 key point here is that the algorithm is going to prevent you if your investment is not direction. Very important, because you don't want to invest or continue investing if your trades are not in your favor. Okay, so that's point one. The point two, which I want to talk about, is when you're getting into quantitative trading, even if you have $20,000 to invest, say for example, you have $20,000 to invest, you start with a very low tolerance, say for example, 0.15. So that means what? You are willing to take a risk of $30 and trade with this component. That means at the time you will learn that, okay, as soon as I invest on something, I should be heading north if you're going long. There is no room for you to go south. If you go south for whatever reasons, it'll stop you right away. Your stop loss could be at, say, um, 1% as an example. I'll come to that later. So the best way for anyone to start this technique is to first have a list, and I'll come to that later again. Your list should be good, and grabbing the right opportunity at the right time is key, very important. So if you can grab the right opportunity at the right time, which we'll talk about in other videos, you will notice that you are heading north the way you expected it. If that's the case, you don't even you have a tolerance of 0.15%, you will not hit that factor at all because you are heading north anyway, right from the word go. So when you start this technique, do not set it up at say 1%. Don't do that. Even if you have $20,000 to invest, start at 0.10%, 0.10, very small amount. Why you need to practice this? Because once you master this technique, that as soon as I get into a trade, I should head north. If that's the if that is your objective, that should be the objective, of course, then in this case you will control your risk tolerance very nicely, because you will be basically you will master the skills of getting into the right stocks at the right time at the right execution. So the the point here which I want my viewers to understand, that in this technique it is all timing. Okay, so it is everything is timing based, and let me again do a new one here. So whatever time you invest, we'll come to that later. Whichever list you invest from, whether it is research or static, whatever, will come to all of those later. But the goal here is as soon as you invest, it should go in the direction as per your expectation. And if that doesn't happen, then you are getting into this situation of risk tolerance. So the technique which I will recommend all my viewers, first learning point is keep your risk tolerance very low, very, very low. 0.05 and 10% is something you keep, and try practicing with this range. So because as such you're taking, basically you're not taking any risk. In other words, $20 out of 20,000 is nothing. But within that $20 risk which you are taking, if you can master that art or skill of every stock selections which you do is going in the direction of what you want, then you have already conquered the risk tolerance percentage. So start very small, start with less number of stocks, because you can be having, and I'll come to these list of stocks and all those things later, but keep in mind that if your selection is stock selection and the execution time is such that it takes the execution and it does exactly what you want it to do, whether it is on the long side or if you are going on the short side, you, as soon as you execute, the stock is heading south. You are in a perfect spot and you don't have to worry too much about risk tolerance at all, because you have already mastered one of the skills that, okay, when I am selecting a stock and I am executing it, I'm getting exactly what I want it to do. So if that's the case, you have mastered one of the areas of your risk tolerance. So that's one of the key points which I would like to mention. So one of the best practices, keep your risk tolerance low as to what I have just said, and test it out if the stock selections are heading in the same direction as expected. So that's exactly what I'm trying to tell you here. So once you achieve a certain degree of success from your list, and the list will be your list of stocks, increase the risk tolerance percentage gradually. Why? Because although you have mastered, assuming you have already mastered this technique, that your selection of stocks are correct, the execution time of the stocks are absolutely correct. Your the time you execute saying that okay it should go long within 10 minutes or 20 minutes or 50 minutes or maybe 1 hour, it is heading to that direction and you get into the profit zone for that particular stock. But now, as soon as you master that skill, okay, it is very important that you understand it and you master it. At that point, you increase your risk tolerance to say 0.25%. Why? Because now you want to pick up more stocks. So first, start with a very low percentage, very low percentage of tolerance. Get to the perfection level first. In a point as to a perfection level here means as soon as you think that something is going to head north after your execution, it should go north. Once you have mastered that skill, you are now looking into lot more investments. So that means if you had invested in 5 stocks, now you start looking into investing in say 15 stocks at the same time with the perfect correct execution. So what happens is you are as an essay that it will look into exactly what you are asking it to do. So you will be looking into 4 or 5 or 6 order executions with say long positions at the same time, and all 5 will go correct. That's the perfection level you need to be. It may take a while, but it's still worth it because you have mastered that skill, you have mastered that timing, you have mastered that list, whatever is your list. And once you do that, out of 5 trades you do, if 4 of them is getting you a profit within an hour, the cash available cash is again there with you. Again, it will look into something else. But you don't want to get into a situation where you have invested the money and you get stuck. Stuck means it is heading south, it is going against your direction. Of course, it did not hit the stop loss, but that will cause capital blockage. You don't want to be in that situation. So the skill to optimize the entry point of a trade execution in the direction of your expectation, whether you are going long or you're going short in the direction of south, if that is correct, you will notice that you will be trading more and more because as soon as the trade finishes with a profit, cash gets released. Within the next 60 seconds, if you're using 60 seconds as your pulled interval, it will look into the next opportunity for you. So your money will keep circulating in the way and keep growing. Of course, your problem as you're milking profit, your money is growing anyway. I don't have to get to that, it's understood. So the goal here is to keep your money circulating to maintain an execution point of entry so that you are way above the tolerance percentage. And if you are there, you have basically won this battle. So this technique is going to help you to master that skill. So once you have so that's what I mentioned that get into a very low risk tolerance to start, and as you master that skill, that okay, you know what, I'm not hitting tolerances, I'm going way above tolerance percentage, and I'm milking profit. So you have invested in say 2 stocks, both of them gave you good results. Now get into 3 stocks, then gradually get into 4 stocks and see if you're getting the same type of a result. So it is very crucial. It is very crucial during the initial stage of setting up the optimization levels that all your trades are going mostly in the direction you wanted it. Of course, there are so many features there. We will come to that a little later, but this is one of the point here which I'm trying to make. The second point here is buying power types. What the algorithm is doing is it is telling you that you have two types of buying power. One could be the fixed and the real time. So if you're looking into the fixed, that means $20,000 was your fixed amount. You're looking into that 20,000 amount, and say for example your leverage is in Interactive Broker, if you say it is 1, means you're using your own cash. That means you're not using anybody their margin loan at all. So you are saying that, okay, I don't want to use leverage, and let me make this as a white here, just to make it clear. So you are trying to tell the algorithm that I don't want to use any leverage. So therefore, I'm keeping that leverage to 1. So don't worry about that. The software will take care of all of it. But if you are telling the algorithm that you don't want to leverage, internally, Interactive Broker will treat it as 1. So what happens is if you are investing $20,000, it takes 1 as your multiplying factor, and it gives you a buying power of $20,000 again. So this is a key point which I'm trying to make. So now say for example, when you have mastered these skills, as I just mentioned above, that all your executions are correct based on the list, you can gradually, so of course you have to have more money. Say for example, you have 100,000, and out of that 100,000, now you're saying that, okay, I want to use a leverage of say 25%. So that means you're looking at leverage of 2, because 1 is your own money anyway. So it gives you a buying power of 200,000 now. So out of this, I'll come to this part little later. So here now you're saying that, okay, I want to use a leverage. So at the time when you're using the leverage, you are telling the algorithm again that I do not, out of this 200,000, I still do not want to use say $50,000. So it will use $150,000 investment with the leverage. So you are controlling it. And then with the real time, if you're looking into real time, you are probably also, you can say that, okay, you know what, I want to only use 25% of my leverage. So there are a lot of ways you can plot the leverage, but what I'm trying to tell you is leverage is nothing but being greedy. Okay, so brokers will always give you leverage, always. Some brokers charge more interest, some brokers don't, but do not get greedy. It is very important. Of course, you don't treat this as a helicopter money. They'll charge you some, and if you're an intraday trader, of course, you're not paying any interest. But if you're going on a long-term trading technique, then you might be landing up paying interest on the leverage. But using of leverage is, according to me, you can be your best judge, is only when you are perfect with all the parameters. At that point, you're executing your trades correctly. Every trades you do is correct. At that point, you can take some helicopter money, right? It's more like a helicopter money. If you're doing intraday trading, you'll probably use a leverage and close all the positions by 3:30, 3:45 and you are done. You don't pay any interest for the night. If you're doing swing trade, maybe you might be on a leverage for a few days and keep paying interest on that leverage. So don't get into leverage unless you are thorough and perfect. There are a lot of people who gets into leverage and gets into trouble. You don't want to be in that situation. Your first here is to make sure that all the executions you do, at least 90% is correct. If your 90% trade executions are correct, you're fine. If it is 80%, you're okay. I won't say fine, but I will rank you as okay. But get to that perfection. Leverage, all the brokers give you leverage, but you're not to, it's advisable not to use till the time you have a complete control on your stock selections, on your executions, you're way below the risk tolerance, and you're milking profits very fast. Unless you get to that point, please do not use leverage. So leverage for beginners is recommended not to use. That's clearly what I'm trying to tell you. Try not to use long-term investments. Leverage, again, as I said, is something which you can use only when you have the perfection of your stock selections, your executions, and all those stuff. But again, having said that, on a long-term investment or a swing trade which could go for 7 days, 10 days, whatever it is, long-term could go for probably 1 year, 2 year, you don't want to get caught in the leverage, because currently, the time when I am recording this, we are in the midst of coronavirus. So if trades go against you, you will be liable to pay interest to the broker. So why even think on that direction? You rather make the perfection in terms of getting the selections of the stock correct, trading correctly at the right time with your own money, and keep doing that repeatedly. I will come to other features where you can do that, and continue this for next 2-3 years till the economy is very good, and at that point you are completely thorough with your executions. Because if this is the skill you master, it will continue every day. It will, once you set it up, you're running the same thing every day. Doesn't matter, from now to going forward next 5 years, 10 years, you'll have the same execution. So please do not use leverage for the time being if you're not sure. Number 3 is, yes, for intraday, you may want to use leverage, but make sure that you have this ratio. If you don't get into 90 is to 10, means out of every 10 trades, 9 trades are in your favor, in the direction in which you wanted it to go, and you got you profits. Maybe one did not. At that point, you can think of little leverage. If it is intraday, go ahead, because your executions are 9 is to 10, which is phenomenally good. So first, master this skill. This is so important that you master this particular ratio. It will take time, but it's worth it, because you can still continue making money from 8 trades to 2 trades, as I said. But using leverage means you're getting greedy, and it is not advised to be greedy for anybody. Even I don't think of using leverage if I'm not sure. So having said that, the take from fund management, which we are talking about, is you are not only controlling your risk here by the percentage, but at the same time you are telling the algorithm that, okay, you know what, out of this 100,000, if I use my leverage to 1, means my own cash, I've only got 100,000 to invest. Out of which you can always say that, okay, you know, the first 100,000 I do not want to use. I'll come to that portion a little later. You are on the buying, on the cash management side here, that I want to use this buying power gradually. But having said that, first of all, in this section of the configuration, you are doing two things. One, you're mitigating your risk. So start very small. I would say even if you have say 100,000, start with 0.10. And if you see, take this as your threshold and you see if you can get to this level of perfection. It is so important. If you can get to this level of perfection where you're not hitting the risk factor at all and you're going north, assuming you're doing long trades or short trades, which will come, you have mastered this area. Okay, so secondly, once you mastered this part of it, then you look into leverage. Say you had 100,000 as original amount, you just use 1.25%, a very tiny amount of $25, although the interactive broker will give you 400,000. Doesn't matter. Don't be greedy. Just use 0.25%, means 25% of it, and use that as a buying power criteria. And when I come to cash management, you will see that how we move from buying power to the cash management part of it. But how much of the buying power you need to have is crucial, which will depend on your success story for the list you make, because this part is very, very crucial when it comes to stock selection and execution of trade. In traditional techniques, we don't do that. I don't think people get into that level of precision when it comes to execution of a trade at the right time, because we cannot do it. Humans cannot do that. But when it comes to quantitative trading, you'll see a lot of techniques are there which you will learn that you can execute a trade every 60 seconds for that matter to scan the market. And when the right time comes, which we call it as a sweet spot, you execute a trade. So having said that, I will conclude this part of the presentation.